In this video, we are going to be looking at how you can find good key levels to take your trade from. You get now, most we suggest that you can find key levels that price must react on, which is technically impossible. You get no key level is 100% accurate. You get a key level or an area of interest or supply and demand or support and resistance zone. They are all the same thing. This is an area that you are watching. Why are you actually watching? Because a lot of people know how to draw key levels, but they don't know the reason why they are spotting those key levels. They don't even know what goes on at the key level. You get now, these key levels, the reason you're looking for key levels is because we say that you don't actually just enter the market from anywhere. You get there are specific prices that are favorable to you as the trader, and those specific prices can be found at these key levels. But then, why are they favorable? I mean, why is where price is currently not a favorable place? I mean, come on. But however, the reason we are looking for key levels is this. Number one, your key level, we understand that. You know what? Let me do this. Let me turn this off and I'll explain it. So, we understand that market can do two things. Sorry, three things, which is it can be trending bullish or bearish. You get, and then it can be doing something like this. And then you can also have something like this. So the question now is, why are we trying to find these key levels? If you already know the basics, if you are watching this video and you don't know the basics of forex, that's the basics of what goes on in the market. I suggest is either you subscribe to the channel, because I'll actually be dropping a crash course on forex trading where I'll be explaining a lot of these things, or you visit babypips.com. The link is in the description. Visit babypips.com to get a grasp on the fundamentals. You get the basics of forex trading, because you will not understand all these things if you don't know the fundamentals. So anyways, as I was saying, these key levels, what happens at these key levels are there are traders looking to take trades or come out of their trades at these key levels. You get, let's say price came from a key level down here. You get, and then there are people who took buy positions here. Now they have their buy positions and take profits at the next key level. You get, now you remember that even from the basics, what we do is we are buying from this key level. And whenever you are closing that trade, what are you doing? You are simply reversing your position. It means what you bought, you are selling it back. You get at a higher price, because what? Price moves higher from here to here. You get, so that's what you are doing. You are selling what you bought for cheap price at a higher price. That's what you are doing. You are simply reversing your position. Now, at the same time, there are those who are also watching this level and looking to sell from this key level. You get, so it's the same thing. As they are selling at a higher price, they are planning to what? Buy what they sold at that high price, and they are planning to buy it cheaper, meaning they will make money. You get, they will profit. Now, the activity that happens when you close your trade, being you are selling, and combined with the sellers here, create that pressure, meaning this pullback. You get this pullback you are seeing here from here down here. You get, so the combined process of these guys closing their buy positions and this guy opening their sell positions creates the selling pressure that pushes price back down. But then let's say that the people that took sales here were not enough to overtake the buyers here. And let's say that majority of the ones that took the buys here are actually still open. And then some people who took the sell ended up closing maybe here because out of fear you get they closed early and then the buyers end up overtaking since they didn't really close at this zone you get. So price then pushes beyond the sellers here, meaning the buyers now overpowered the amount of sellers here, so it pushes up from there. So you see that those of them that didn't really close here begins to close after maybe price has broken the zone you get. Or let's say there's another minor key level there and you have some people selling a short-term sell. This like it's the same process. They close here, then price pushes down. The sellers here will close and buyers here will push price again. And then this happens. This is consolidation. And this consolidation or ranging market, we already know what it means, that the equilibrium between buyers and sellers has been achieved. So the buyers and sellers are, should I say, equal at this moment. Well, not textbook equal as to say 1 to 1, you get, but it is relatively equal. Let's say ratio 1 is to 1.5 or 1.8, you get. So the imbalance is not so great to push price higher or lower. And then you begin to have this kind of movement. You get, you begin to have that kind of movement. So the basics of these key levels, these are levels that every other trader is either looking to get involved or to get out of the market. That is why the key levels are important. That is the simple basic as to why key levels are very, very important in the market. So knowing this knowledge now, we now understand the few tips now that I'm going to be dropping as to finding good key levels. So number one is this. Traders will say zoom out. Yes, you get, zoom out to find good key levels, which is not wrong. But why are you actually zooming out? Because the thing is, understanding the concept is better than just the process. Okay, you need to understand the concept. Why are you even zooming out? So the reason you are zooming out is simply because you are trying to find the key levels that are extremely obvious. That are extremely obvious, that very, very visible to majority, if not all, the traders. You get. So why are you looking for the ones that are very obvious? If you remembered what I just explained, we said that the key levels are levels that we are expecting other traders to be watching. You get, and then traders that got in here will look to get out here, and the ones that are seeing this place will want to get in is sell here, and will look to get out here, buy here, sell here, buy here, sell. That's the simple process. You get. So that's the concept. But if other traders are not seeing the level you are seeing, then consider that level to be weak. Because definitely there will be others, there will be a few that are seeing it. But remember, it's majority. You have to ride the market. Riding the market means you are riding with the wave, you are riding with the majority. If you are a surfer on water, now you ride the wave. You don't try to create your own wave or anything. You ride what is given to you. You get. So it's the same in trading. You ride what the majority sees. And how can you know what the majority sees? It's simply picking the most obvious ones. You get, the most obvious ones. Like as I'm zoomed out now, I don't really need anything, any zone that actually stresses you to see. That is, you need to zoom in to see that zone. Consider it a weak zone. That is not bad, but it's a weak zone. You get. So that's the first tip. The zone should be very, very obvious. It should be a very, very obvious zone. You get. You should not need to have to zoom in to start looking for these small rejections within here. All those ones, they are minor zones. So your major zones are the ones that are very, very obvious. You get. So the number two tip I'm going to be giving you is this. Now, let's say, like I've given you the tip that you should take zones that are very, very obvious. But then another place that the problem comes in is when you begin to drop down into lower time frames. Now, if I am to go into the daily time frame, you see that this initial zones I drew it from the weekly. You understand? So if I'm to drop down to the daily time frame, I begin to see more zones that are actually obvious in the daily time frame. Get places like this, like it's very, very obvious to the eye. And if I should still drop lower into let's say, let me just use the 1 hour time frame, you see that the 1 hour also has its own very obvious zones. Places like this, like I don't need to stress to see them. Places like this. So if you are seeing this now, you begin to get confused. This is where conflict comes in. You get, because you can't say you are taking a trade here and you are planning to come out at the next zone, which is like just here. Let's say you took your trade and then you're having 1 to 1.9. Like, it doesn't make sense. You'll be having bad days to reward, and then sometimes these um zones being everywhere can lead to what we call the analysis paralysis, meaning you analyze, and after analyzing you can't take the trade because you just end up being confused. You just end up being confused. So how do you overcome this? That brings me to the second tip. Now, this I'm going to be saying, just like the title says, is focused on swing and day trading because I'm a swing slash day trader. You understand? Um, you should pick the time frames that you'll be drawing your zones from and focus on those time frames for your zones only. You understand? So what I'm saying in essence is this: your zone, I picked the weekly and the daily to draw my zone. You get? So this is an obvious zone. This here is an obvious zone on the weekly, right? On the weekly. And then I decided, all right, I'll still drop down to the daily to find intraday zones. You get, these are the ones that will lead to my day trades and not my swing trades. So for me to differentiate between the weekly zones and the daily zones, what I do mainly is I use the rectangle tool for my weekly zones and I use the line tool for my daily zones. So daily area of interest. You get. So it's that simple. If you see now, you see that price is at the zone, like it's literally at that line. Multiple rejections, rejection, rejection. Get, rejection, rejection. So knowing this, price is at this zone now. At this point now, I'm considering a probable sell position depending on what the market presents. Because if you watch this, you see that it initially rejected that zone and traded down. What was happening? There are people who traded from levels like this, and then they took their profit here, and some initial, that is aggressive sellers, took a sell position. But as you can see, there were not a lot of sell positions to overpower the buying power. That is why you can see something like this. Now, price took how long to cover this distance? That's from here to here. Now it took 14. It takes 14 days. You get. But then let's check the power. See this now. It took 12 days to recover from that fall. You get. So the time and price ratio tells you that the buyers are, some, like, several levels stronger than the sellers. However, that's for another video. This is what I'm talking about. You should take your trade from I say your trade. You should draw your zones from specific time frames. Just like I've chosen my weekly and daily, and I only trade off of these zones. You get? I only trade off of my weekly and my daily zone. So you as a day trader can draw your zones from the daily and the 4 hours, and then take your trade only whenever price gets to a 4 hour zone or a daily zone. You understand? Then you can use the lower time frame, the key levels on the lower time frame, to set things like your stop losses. You get that will be in another video, but for now I wanted to take this away. First of all, your key level should be extremely obvious in whatever time frame you are drawing it from. It should be very, very obvious, because you understand the concept now of why it should be obvious, because it's an area where you're expecting every other trader to be watching. Get. So if other traders are watching it, and you also get in along with every other participant in the market, you end up going the same direction with everybody. You get. That is the easiest tip I can give to you. Then the second one is kind of a cushion to avoid the analysis paralysis that happens when you keep drawing key levels everywhere. You get. um there's something, someone I used to follow, a mentor, used to tell me. I've forgotten. I think it was, I was listening to Photon. It was a podcast. If you are aware of Photon trading, I don't know if you are aware of him. He's a smart money concept trader. But I remember a statement he made. He said, "Bring your madness to the market." You get, bring your madness to the market. What that simply means is that whatever you are doing, there's no specific golden strategy. You get, there's no golden strategy, there's no golden law or golden rule or whatever. You get, the thing about trading is you should make sure that whatever you have brought into the market, you are going to stay consistent with that. So, like I said, that you should only trade from the weekly and daily. Stay consistent with that law for you to benefit over time. You get, because if you begin to switch from the daily, you begin to take trades off of 1 hour zones, you begin to take off of 4 hour zones, like, you just mess up your entire trading. I don't know if that makes sense. So it is better and best for you to take your trade off of specific time frame key levels, and then whenever price gets to the next key level on your time frame, you look to either get out or watch for market reaction. You get. So if you are interested in more contents like this, and if you think you benefited from this video, you learned something new, something useful, do well to subscribe to the channel, because I'll keep dropping videos and educational content like this. I'll be dropping market updates. I'll be dropping trade reviews, that trades I've taken, and I'm kind of explaining my thought process to the trade. You get. So I'm actually planning on doing one soon for Euro GBP. For Euro GBP, I think it should be on the 1 hour time frame. I'm actually planning on doing one for this trade. So if you are interested in seeing things like that, do well to leave a like and then subscribe. Also, do share these videos, because I know definitely a lot of traders are going through a lot. That's a lot. When I say a lot, traders go through a lot, and the problem is information is too much. Like, there's a lot of useless information out there put up by gurus and mentors, and I don't mention any name because you technically don't know who is who. You get, even me. You get. However, let the results, you get, let the results speak for the mentor. You get. Whatever he's saying, evaluate what he's saying. Crucially, that be a critical thinker. Think for yourself. You get. Evaluate what he's saying. Does it make sense? Does it apply? You get. That's all I have for you guys.